Right. Well, welcome to dedicated to dividends, a tongue twister in itself. Thank you very much for coming to this session. I'm very glad to see you all here today. You're obviously here because of the wonderful income advantages that investment trusts have, including the ability to reserve income to pay it out in future years. And the managers that I have here, which I'm very fortunate to have, are very highly focused on delivering reliable dividends from portfolios of UK and global equities. So you may know me. I'm Moira O'Neill. I write regularly for Financial Times Money as a columnist. I also write for other titles such as Investors Chronicle, Money Week occasionally. And here are my panellists. I've got on the end, it's Faizan Baig of Henderson International, Ian Lance in the middle of Temple Bar, and Thomas Moore next to me from abrdn Equity Income. So we're going to explore their strategies for maintaining and growing income over time while protecting shareholders' capital. So I think we're going to start off by pitting you all against each other, because we've got a healthy selection here of UK versus overseas. So Thomas and Ian, should we start with you on the UK? Why should we be investing in the UK for income? Thomas.
Okay, well, it's a huge market. Even now, there's been lots of de-equitization, which means companies have been buying back their own shares and they've been taken over. So there's been a reduction in the number of companies, but in the FTSE All-Share, there are still 561 companies. So that is a huge range of companies from which to choose. And if you take an index-agnostic approach and you say, well, actually, I'm going to buy the companies that I think are going to deliver the best returns, that's plenty to be going on with. So we don't need to broaden out further than that. And of course, in the UK, we've got the rule of law, we've got actually a wide range of winning industries. So we get a hard time on macro issues, and that's weighed on returns in the last 5 to 10 years. But actually, there are some great companies out there. So we just think you drill down and look for those gems within the UK market. Brilliant.
Ian, you may agree with some of that. I'm sure you do. But what's your view on why invest in the UK specifically for income?
It's actually the valuation advantage the UK's got at the moment. So if you look at the dividend yield on the UK is just over 4% at the moment. If you add buybacks to that, that's 6%. That's higher than in any other market in the world. So you've got an instant income advantage and share buyback advantage. That said, I will say that this is going to be a slightly sitting on the fence answer. Temple Bar can invest 30% overseas as well. So we do take advantage of that flexibility to invest overseas as well as just in the UK.
Okay. And how much are you
we're at
weighted?
30% at the moment.
You are,
yeah,
yes. Okay.
Yeah.
Great. So, Faizan at the end. Let's go international, overseas. What's the rationale there?
Sure, absolutely. Thank you very much. In terms of international markets, the appeal is entirely to get access to industries, sectors, and countries that you wouldn't access through just owning UK equities directly. Even though UK stock market certainly has international revenue exposure, we think that internationally there's quite a bit going on that's very exciting on the income front. We have industries within technology such as semiconductors, software, which are very much changing their attitudes and paying more and more dividends. And there's a big shift from what it looked like perhaps a decade ago. And so we think that that is something that income investors should certainly be aware of. The other thing is also in terms of diversification of economic and political risk. When you think of the entirety of your portfolio, if you own UK income stocks, having an overseas allocation certainly helps protect you on that front, on a risk front. And then if you look at the figures, I think the UK, in terms of total dividends paid in the world, is only about 5%. So there's quite literally a world of dividends out there.
Yeah, world of opportunity. So it looks like, as investors in this room, we've got to consider both from what I'm hearing so far. Now, let's hear what the specific trusts we have here do, and let's get a little bit of an introduction from you each. What are you aiming to achieve for investors in terms of dividends? What's your track record look like? And what sort of yield do you aim to offer? So, Thomas.
Yeah, I have a dividend growth and dividend growth track record of 23 years. I took over in 2011, so I've maintained that long period of dividend growth, and I don't intend that to change under my tenure. So that's the first point to make, that we are covering our dividend, we're achieving dividend growth. But I think importantly, the valuation opportunities that Ian just referred to, I am grasping with both hands. And what I mean by that is that actually, if you look at the yield on this trust at the moment, we're covering the dividend, we're actually generating a yield of just under 7%. Now that sounds high, and you may say, oh, sharp intake of breath, there must be some value traps in there. But actually what's happened is that we believe that fundamentals have become completely dislodged from share prices across the UK market. We've continued to cover hundreds of stocks. We believe that many of these situations are completely the wrong price. And whilst at different times in the cycle, it might be the case that we have a different approach and that we actually increase our weightings towards stocks which are seen as more growthy stocks. Right now, we think the opportunity is the most mispriced stocks are actually those high free cash flow yield stocks, which is generating the cash to pay the dividends. So I look across the market, it's an index agnostic approach. And we've got, so I'd say the two key differentiating factors of this trust are we're pure UK. That means we've got hundreds of stocks to choose from. We are index agnostic, so you'll find stocks which are small caps and mid caps right up at the top of the portfolio. And on top of that, we've got this very attractive dividend at the moment.
Thank you very much. So, Ian, would you like to introduce your trust and what you're trying to achieve, your track record, etc.?
Yep. Okay. So, Temple Bar is a nearly £900 million investment trust. It's nearly 100 years old, amazingly enough. Myself and Nick Purvis have been running it since 2020. I suppose we are best known for our value style of investing. And so although the trust objective is capital and income, we've always seen ourselves as total return investors. And since we took it over, as I say, we took it over the tail end of 2020, the trust is up 125% versus about 65% for the market. So we've nearly doubled the return of the market. So, I think it goes to show that we can generate a pretty healthy capital return as well as income.
Fantastic, thanks. Faizan.
Yes, so the Henderson International Income Trust was launched in 2011 with the goal of giving UK investors access to overseas dividends and capital growth. And so obviously very happy to say that we've been able to do that over that time. Our NAV has just hit a record high recently. And the dividends, we've grown our dividends consistently at roughly just under 6%, which is about double the rate of UK CPI. We've just been designated as an AIC Next Generation Dividend Hero. And so the view is entirely to complement perhaps what you might have in your UK equity allocation with international sort of version of that, and potentially with very attractive growth levels.
Brilliant. Thank you. Now, I'd like to gauge what's going on in the room here. Who among you is investing for UK income already? Can you raise your hands? A healthy show of hands. And who invests for international income? Slightly fewer. And who does both? Oh, it's almost the same, actually. So, thank you. And obviously, we've got some great expertise here. If you do have any questions, burning questions, raise your hand now. If you don't have any yet. There is one at the back already. Brilliant. Thank you very much.
Brilliant. Really useful talk so far. My question's predominantly for Henderson International. It was interesting you referred to the performance in NAV, not share price, because I think probably a lot of shareholders will have noticed in the last year the discount has widened materially, I think it's fair to say. To the extent probably I'd be keen to understand what the company's now doing to address that. If you compare the discount to Moira International and Scottish American, it's materially higher than the others in the sector. So just really curious to know what the plan is to address that.
Okay.
Yeah, sure. So obviously we keep an eye on discounts, not just for the investment trust itself, but for the peer group as a whole. And we have been tracking sort of how the entire peer group has widened over that period. We don't have a set, if you like, sort of discount management policy, but the board does retain flexibility to act when they feel that we have gone beyond a certain level versus the peer group. And so that's something we certainly monitor on an ongoing basis. We also think about the balance between income and NAV returns. So we have spent a bit of time building up reserves and a bit of focus towards sort of, building up a very strong set of reserves. And this is sort of in the post-pandemic world. You may remember dividends were cut, and it was a difficult time for, shareholders in different sort of types of funds. Obviously, being an investment trust, one of the benefits is you can earn lots of income in a certain period of time and pay it out later. And our approach certainly going forward is perhaps to leverage off that to think about NAV growth at a higher potential rate. I'll certainly invite you to read our annual report, which should be out in about 3 or so weeks from now. And I'll give you a lot more detail about that.
Great. Thank you very much. So moving on, I think I'd like to talk about how you balance delivering attractive income, which everybody in this room wants, with growing that income over time, because we've all just been through a period of high inflation. We may be worried about retirement income and how it's sustained, because a lot of investment trusts are used for that. Is there a trade-off to be made, or can investors have it all? Thomas, would you like to start?
Yeah, I think market conditions will dictate the answer to that question, Moira. And I think that is I think in the last 3 years when actually it's been a pretty torrid period for many income stocks, post-COVID, a lot of companies cut their dividends. And often there was a correlation between dividend cuts and share price performance. So there's been this sort of rather difficult period of managing income. However, now what we're seeing is with some green shoots. Now, obviously, we've got to wait till 30th of October to see how sustained those green shoots are. But in the UK economy, we're seeing some mild growth, and the same in the US. Europe's a bit tougher. But we are starting to see a lot of companies having the confidence to come back with pretty attractive dividends. Now, what the key to the answer to this question, Moira, is that we believe we can do valuation re-rating at the same time as incomes grow. And the reason why we're confident now, more than ever before, is that the starting point of valuations is so low. Another way of saying that is, well, free cash flow yields are high. That means lots of free cash. Companies have got to choose what to do with all that cash. And some of that cash will be used to grow dividends. And so that's happening. And so the yields on offer at the moment are unusually high, and I can talk about a range of different stocks and sectors that fit the bill. And what we're starting to see, stock by stock, is we are starting to see that re-rating coming through. Now, I'm going to throw a name in now just so that we can, and we can come back to it if anyone's interested, but Imperial Brands was seen as uninvestable 2 or 3 years ago, and it was yielding over 10. They had a new chief exec who came in, turned the business around, initiated a buyback. So you've been getting a combination of buyback plus dividend. Initially of about 20, it's now come down to about 15, 16, about 8% dividend, 8% buyback. Now that is a re-rating at the same time as the dividend is growing. So I truly believe if you look hard enough, even in the mega caps, you can find stocks that can do both.
Brilliant. That's quite inspirational. Great. So let's think about capital growth as well, because balancing the income with the capital growth, does it have to be at the expense of capital growth? Can investors reasonably expect to grow their capital? Ian, what's your view?
Yes, I think they absolutely can. Nick and I have, as I said earlier, always thought of ourselves as total return investors, and most of the time there is an overlap between the highest yielding part of the market and the best value part of the market. But occasionally there aren't. And there have been 2 times in our career that we have written to our investors and said, we're going to cut your dividend. But there's a good reason for it. And you're going to be rewarded by capital growth as we come out of it. One was in the financial crisis, and the second one was during COVID. So lots of the cheapest parts of the market during those 2 periods of time were companies that had just cut their dividends, so you could buy low-yielding companies, and then you got an amazing capital return as you came out the other side of that. And then at an individual stock level, we will occasionally buy a company where we basically think it's a recovery type company. So, we bought Marks and Spencer's a few years ago, had no dividend at the time, but the growth is starting to coming through. So effectively what you're looking at is future earnings growth and future dividend growth.
Yeah. Same to Faizan about the balancing aspect of the income versus growth, and then growing that income as well. How does that work in the international sphere?
Sure. So, we clearly see 3 separate sort of buckets of sectors. The traditional income sectors are probably more mature industries. There isn't a huge amount of growth there. They're effectively handing you back cash because they can't find great investment opportunities themselves, which is fine. But then on the flip side, you do see in this market today and in years gone by, lower yielding companies perhaps, where there are dividends and probably better dividend growth, and there's a focus on potentially growing the company's revenue by investing in new areas and having new products or having a technology advantage. I can certainly talk to stocks that we've owned in the portfolio for a very long time, such as Microsoft and TSMC. We've probably owned them for over a decade. I think the compound annual growth rate is about 23-24% per annum, and they've grown their dividends by double digits over that period, which is quite impressive. I'm not going to say those are the standard companies. Those are sort of the really good performers. But on the flip side, in the high yield side of life, as the panelists mentioned, there are many occasions where stocks get mispriced. The market gets extremely negative. There's fear, and all you have is bad news. And for us as income investors, we always take a look at those companies. We think about where the opportunities might lie for a turnaround. We think about the industries those companies are operating in and whether they may present opportunities to you. And I'll maybe give you one more tech example just because it's probably more relevant. So last year, in around September, I went to Hong Kong and met with Hon Hai Technology, which many of you may not have heard of, or some of you may have. They're effectively an assembly business. They put together things for the big tech companies like Apple and others. And they told us that they had just won lots of business with NVIDIA. The stock was trading at a dividend yield of 5.5% and a single-digit PE. We've owned it since. It's up about 92% year to date, and we've captured all the income. So
wow.
It isn't always possible.
That's a success story. Great.
But, yeah, that's how we do it.
Thank you. Are there any more questions from the audience now? Can I open this up? There in the middle, the gentleman in the middle. There's a microphone winding its way to you now. There we go.
It was a question mainly about what do you think about the sizes of the companies that you're looking at for your income? Big ones compared to small ones. Are they changing, or are you expecting to be similar going forward?
Ooh, big versus small for income. Big. Who would like to take that? Ian, would you like to take that?
I mean, we are remaining large cap at the moment. And that is not to say that we don't think the small cap area is cheap. There obviously is quite a lot of valuation in the small cap area, but the liquidity is horrific. I would not want to be a small cap manager running an open-ended vehicle at the moment, because meeting redemptions must be an absolute nightmare, selling your own stocks, driving down your own share prices, etc., etc. And when you can find as much value as we're finding in the large cap area, we just don't think you need to go down into the small cap area and have that sort of a disadvantage of liquidity.
Great. You all seem to be in agreement. I'm seeing a lot of nodding, and is that right?
Yeah, I mean, I would add to that. I think Ian's right. I think especially in the last 2 or 3 years, large cap's been a very good hunting ground. I think what we're waiting for with small caps, given that they're mainly domestic revenues that these companies generate, there are, of course, some very good international earners within small caps, but the bulk of the revenues coming from smaller cap, mid-cap stocks are UK. We're waiting for this elusive pickup in economic growth and consumer confidence. So it wasn't great that we had the change in government and then immediately lots and lots of cold water poured on people's expectations. That wasn't an ideal scenario for small caps and mid caps. And we've had conversations just in the last few weeks with companies exposed to the consumer who are just saying, you know what, it's really tough still. And that will affect lots of small caps and mid caps. But of course, beyond the 30th of October, if they can get the narrative right and just say, look, actually, we're going to go for growth. We're going to find ways to stimulate parts of the economy which have a good multiplier effect. That could be a great time to be looking at small caps and mid caps again.
Brilliant. Thank you very much. Now, we've had a few mentions of specific companies so far, but I'd like to ask each of my panellists, do you invest in any companies that are rarely found in income portfolios? So is there anything in your portfolios that's unusual, exciting, that people might not have heard about? Yes.
Yeah.
Okay.
Shall I mean, I was just struck by the fact that I thought I recognised this address. The great Lord Crudas, I suspect, is in the building at CMC Markets. This is one of the largest positions in my portfolio. I don't think you'll find that in many income funds. And I think it's important for me to have really been on a journey with Lord Cruddas. I think he's a character. I don't know if any of you have come across him over the years, but the great thing about a founder like him is he invests for the long term. And so, yes, there have been periods of wobbles, there have been profit warnings, and that's tested a lot of investors' patience. But actually, you know, the fact that he then goes on to deliver what he said he was going to deliver, JV with Revolut recently, which has got people quite excited, which could expand them internationally. And actually the fact that then suddenly the dividends start surging. So instead of, I think people were expecting a 3p dividend back in about May, and he announced an 8p dividend. So these can be very interesting. Make sure you carry on following stocks when they've been through a rough time, because your knowledge about, I'm sure in this room, there's lots of knowledge about small cap stocks, which may be out of favour now, but make sure you keep on top of them, because their time will come again.
Brilliant. Ian, is there anything surprising?
I mentioned it earlier on, which is dear old Marks and Spencers.
Right.
So change management a few years ago, a very capable chap called Archie Norman comes in, identifies all the problems with the business, starts to fix them. Believe it or not, during the pandemic, the share price got below £1. They produced 25p of earnings last year. So it was trading on 4 times the earnings that it produced this year. And the business has now got just absolutely phenomenal operating momentum. So unusual, because at the point that we bought it, it was paying no dividends. You know, they a couple of years earlier had a rights issue to do for their venture with Ocado. So unusual from that point of view.
Great, thank you very much. And Faizan, with your international portfolio.
Yeah. So might take it in a slightly different direction. So things that we own that maybe aren't as visible in some of the funds similar to ours might be, we tend to keep a close eye on things like spin-offs, which come out with dividends and good balance sheets. And we also look at sort of new issues coming to market sometimes with dividends that people just don't know, haven't heard of. We bought such a company. In fact, it goes back to that question on mid-caps. We actually bought a mid-cap US stock about 3 years ago that spun out of Pentair. It's called nVent Electric. They effectively do electric wiring and enclosures in buildings. You wouldn't think it's very exciting, but actually turns out that the more data centers you build, the more electric wiring you need. And so we've done quite well in something like that. It's I think quite well held now, but perhaps was something very unusual at the time. The other thing I'd say is we do spend quite a bit of time looking at different countries and what's happening there on an income basis. So what I mean by that is, I've probably been going to Tokyo every 2 years for the last 7 or 8 years, and only about a year and a bit ago, you know, the Tokyo Stock Exchange has effectively become an activist, saying to companies, your returns are terrible, your valuations are terrible, and guess what? Your cash return to shareholders is one of the problems. Can you please fix this? And so for us, that's really exciting because we can find businesses which have the potential to unlock this dividend payment that's never been done before in sort of the decades of its existence. So those are probably the sorts of things that are slightly unusual for us.
Great. Well, thank you very much for your excellent tips there. Let's go back to the audience. Has anyone got anything they'd like to ask the panellists? There's a gentleman over there in the middle.
Thank you. Really a question for Ian and Thomas. You mentioned the 30th of October coming up. Just wondered if you guys worry about the Chancellor's ability to maintain the confidence of the gilt market while she moves the goalposts on borrowing, and the extent to which she might turn out to be a bit of a kind of the much ridiculed Liz Truss Mark II.
Is anybody worried about what might happen in the budget?
Yeah.
Yes. Yeah. Okay. Thanks.
Yeah. I mean, it's sort of hard to say at the moment, isn't it? Because there are so many rumours flying around of what might or might not happen. None of them, from my point of view, seem to be particularly positive. I can't see that taking capital gains to 38-40% is going to be particularly positive. I do find it quite worrying. Actually, I'm going to be honest with you. I was sitting in the green room, sort of flicking through LinkedIn, and there are loads of posts from people in Dubai and Abu Dhabi, and basically saying, "Come here."
Oh no!
Leave the UK and come here. So it's Yeah, I'd love to put a positive spin on it, but at the moment I can't see an awful lot positive coming out of that. The only thing I can see as positive is that she's setting expectations so low that it can't possibly be as bad as they do.
Fair enough.
Yeah. Now, I would add to that, I agree with all that, Ian, and I would add to that markets in the end were sovereign when Liz Truss tried to do what she attempted. Markets are still going to be sovereign this time, and you can already see that, the fact that gilt yields are ticking up. And if you look at the spread between gilt yields and bund yields, I was sitting down with my fixed income colleagues yesterday afternoon, and I said, it isn't a UK thing, is it? And of course, they then rather shocked me by saying, Thomas, actually, yes, it is when you look at European bond markets. Not so much against treasuries at the moment. And so the debate at the moment is, are UK gilt yields going up? Partly, obviously, because of worries about fiscal rules being broken or changed, but also could it be, on a more positive note, that UK growth is turning out to be superior to German economic growth or French economic growth, and actually, for that reason, because we've got reasonable levels of employment, etc., look, the UK economy does need slightly higher rates than Europe. Now, and if you look at the strength of sterling over the last few weeks, again, that would tend to lend some credence to that argument. So, look, I'm equally worried, but I hope that, what was described in The Guardian by a senior Treasury source as complete disarray yesterday, if you read that article in The Guardian, that indicates that nerves are fraying within the Treasury about the toing and froing on all these issues, and it's having an impact on consumer sentiment and therefore the economy.
It is. Actually, can I just follow on that point? I was with a media company recently, and they actually said all this gloom and doom from Starmer and Reeves in the last few months, their customers have started to sort of slow down orders, and there's a lot of uncertainty, and it is starting to have an impact on the economy. So they need to reel that in as well.
Oh gosh, right, yeah. Oh, it's a bit doom and gloom.
Yeah, that's it,
Should we get more doom and gloom? I'm going to ask Faizan about the US now.
Say something positive before people start leaving.
Well, I can ask you about that. So we've got the US election coming up. What do you think the impact's going to be on companies in your portfolio?
It's obviously a very important election, and it's important for investors to know what the outcomes could be. But one of the things we would point out, I think, is just that things don't always play out in markets the way you might expect them, just on the basis of sentiment. And that diversification is generally a good idea into sort of outcomes of this sort. When we look at the two candidates, they do have things in common. So, for example, they both hate China and want to be very tough on China, and we certainly see the impacts of that, not just in companies in China, but in European companies that do business there, in US companies that trade, etc. The difference that they have between them is probably on tariffs and taxes. You'll remember when Donald Trump got elected as president, there was a lot of negativity going into his potential victory or the fear of him becoming president. But actually, as soon as he became president, markets took off because he put in this plan to cut taxes. And it's interesting, he's actually speaking of doing the same thing again. So we're not necessarily taking sides. We're very aware of the risks in each case in terms of the policies that they've outlined so far. And obviously, once the election result is out, which is very, very close, we'll certainly assess where we'd like to lean further into.
Okay, great. Ian, you've got exposure to global and UK. Which is preying on your mind most, budget or US election?
Probably budget, actually.
Really?
Yeah,
Yes,
I think so. I mean, the other thing that they've both got in common, both the candidates have in common in the US, is they both seem to like running massive deficits, don't they? So I don't think the deficit is going away anytime soon. And actually that has been net positive for US corporate earnings in the last few years. It might not be so positive for US treasuries going forward, but it's certainly been quite stimulative for US corporate earnings.
Great. Thank you very much. Now, has anyone got any more questions to ask? I'm conscious we've got 10 minutes left in the session, so anything burning you'd like to ask, please raise your hand. Can't see any. So let's talk about, one at the front. Thank you. Excellent.
Are there any sectors that you think are uninvestable for whatever the reason?
Cracking question, thank you. Uninvestable sectors.
Can I go with that one?
Oh,
It's one of our favourite words. Mention no names, but Terry Smith called banks uninvestable about a year ago. And a lot of them are up between sort of 50 and 70% since he wrote that note saying that UK banks are uninvestable. The reason I say that is that when people start talking about something as uninvestable, that means that they're not even looking at them. So they're not saying, I'll buy these things. They're basically saying I won't buy these things on 5 times, 4 times, 3 times, 2 times. They just won't buy them. And that's good news. If you are someone who's willing to sort of be contrarian and do the work, then actually I love other people talking about things as uninvestable. Energy sector a few years ago, all the ESG crowd was just saying you can't invest in energy stocks for ESG reasons. And of course that meant that energy stocks ended up as phenomenally cheap and ended up being very, 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 very good investments. So yeah, we love uninvestable.
Great. So can we name any though? Can we name anything that's uninvestable at the moment? Or is that just jinxing things?
Well, I think you just said a 3-letter acronym there, Ian. ESG, of course, we do a stewardship and we look at the corporate governance of companies. We engage with the companies. Of course, we do all that. And of course, actually, over time, if these companies are investing for the long term, they will be doing the right thing on ESG. But you knew there was a but coming there. When people say, I'm not buying that because of ESG, or I'm not buying that because of XYZ high-level reason, that normally you should be licking your lips with the excitement that brings, because that will create valuation opportunities. And I think that we've all grown up as an industry. I think the industry's changed. I think obviously the FCA is looking at SDG rules at the moment, and I think that there's a much more honest conversation going on now. And I think that I've not had to fight back. My directors have been very supportive of me and my investment trust all the way through, and said, look, we want you to have the broadest investable universe possible. And so it's not been an issue for me. But for those people who have reduced their investable universe to a handful of sectors, good luck. Good luck outperforming when demand for oil exceeds supply of oil, which will happen again. We've been talking about the end of fossil fuels for a very, very long time. We talked about electrification. Demand for some of the commodities that the mining companies produce. Look, that's going to continue for years. So look, I think it's a real advantage to have, as Ian said, you think you answered it very well there, Ian. This word uninvestable can create these opportunities.
Brilliant. Can we look international for it? Is there anything in uninvestable internationally?
Sure. So I might not suggest that there are any sectors that are specifically uninvestable, but rather that the income universe is full of industries which are potentially facing disruption or existential risk. And those are probably the ones we want to avoid. You'll often see many companies trade on very high dividend yields. You think, well, surely this dividend yield will compress. They're making great amounts of cash. They've got a good balance sheet. There's great yield available. They'll make some income. And then 3 years later, you look back and actually your stock's down 20 or 30%. And what's happening is that we're trying to pay attention to areas where the world is just moving on. Many years ago, TV was a fantastic industry to invest in. We used to get great cash flow, fantastic dividends from them. And then, one day Netflix turns up and the game has changed. And similarly, there are many other industries, physical retail, obviously, M&S was mentioned again. It's not just a one-directional change, though. Industries can go through disruption and challenges and then come out on the other side having a very good strategy. And in the case of retailers, that's having a great omni-channel strategy to compete with e-commerce, for example. So when we think of sustainable dividends in light of our target of growing dividends for shareholders long term, we're looking for companies that we think can credibly grow their business and therefore credibly grow their free cash flows and support that dividend growth.
Okay, right. Anybody got any more questions? Because we've got 7 minutes left now. No. Can we talk, therefore, about UK equities and sentiment? We've had there's a lot of talk about this. We had the mention of Brit ISA. Brit ISA is no more. There's a plan for pension funds to be more invested in the UK. Do you think all of this is going to have an effect? You want to go first, Thomas?
Shall I go first? I think I think at the bedrock of all of this is we are, as human beings, we have a recency bias. So we see NASDAQ outperforming and we extrapolate that. And I think human beings around the world have done that. I mean, I'm married to a Norwegian, and the Norwegians are scratching their heads, so why is the Norwegian kroner collapsing? And you know what, some very sensible people are actually saying there's quite a big capital outflow into NASDAQ and into the S&P. That's one of many reasons. But I heard that and I suddenly thought, actually, this is a global thing, that people are being pouring money into growth stocks. And really, if you want growth, you go to the US. Now what's happening in the last 6 to 12 months, I think is really interesting, is that UK equities have started to fight back. And I think that the returns that you can generate, if you look at the total return year to date across a range of UK stocks, have actually matched US stocks, and in even, I would say, tech stocks. Actually, it's maybe the first or second year that's been the case. So actually, that's the first thing to say is, aside from all the will she, won't she for the 30th of October, the real thing that will catalyse an improvement in sentiment towards UK equities is price momentum. Price momentum begets price momentum. It's age old, and what's so lovely is that the gate is very narrow when the flock of sheep are trying to get through, and it's impossible to buy them. And I think that will be a lovely experience for those of you who are exposed to some of these wonderful UK companies which are not so liquid, when people decide it's okay, it's fine to buy them again. And I think we're approaching that time now.
Brilliant. So, Ian, do you have a similar view or on UK sentiment?
It was the subject of the presentation I did in the previous session, which is that UK equities have been cheap for a long time. In the last 18 months or so, we've actually seen two very clear catalysts, which is corporate takeovers and share buybacks starting to come through and drive value in UK equities. And actually what was encouraging was that actually after sort of years and years of outflows, we started to see marginal inflows back into UK equities, so certainly into some of our funds, in the last few months until the last couple of months, when again Star and Rees are doing their best to dampen enthusiasm. So the discount on Temple Bar has just gone out recently, and I think we're told that is investors basically potentially booking capital gains ahead of an increase in capital gains tax in the budget. So, I'm hoping that will be a temporary phenomenon. And then when we get to the other side of it.
I've certainly had a few Financial Times readers asking me about capital gains and that kind of stuff recently. So that
and
adds up.
the amount that you can draw down out of your pension, that's another thing. People have been taking money out of pensions, haven't they? Worried about the fact that that's going to be reduced. And the net of it all is it has led to selling.
Yeah, whether all of that's advisable is up for debate, really, because we don't know what's going to happen.
Absolutely
so
right.
Trying to preempt, the tax changes is a tricky game to play. Can we talk the dividends? So how high is too high for dividends? Because you're all really up against what you can get in the bank, aren't you, essentially, which is 5%. And what do you need to make sure that if you have a high dividend, it's sustainable? Faizan, do you want to go?
Sure, absolutely. We tend not to have a strict cutoff in terms of how high a yield can be. We've bought companies in Asia sometimes where yields have been extremely high, potentially also double digit. And we invest in companies where the dividends are probably far below the bank rate at the moment, but where we feel that there's a great opportunity for a total return to shareholders. When we think of high yields, we do often pay very close attention to balance sheets and the risks around high yields. I mentioned earlier this idea of industries going through change and industries not being able to sustain the level of growth that can eventually lead to the payment of those dividends. That's something we pay attention to. I was thinking earlier, there was that question on mid-caps. And one of the things we pay attention to, not just on a mid-cap level, but large caps as well, is just how responsible are management teams when they allocate capital to investments. So if you're a business that has one product or one industry you focus on, and you just committed the next 3 years of your free cash flow to a factory that you build because you think that there will be demand at the end that'll satisfy that and justify the entire thing, you just potentially put yourself at risk. And when we think of high yields in sort of sectors and companies like those, that's probably something we'd shy away from. So there's no specific cutoff for yield, but there's definitely an evaluation of the sustainability and growth, as I mentioned earlier.
Great, thank you very much. I think we might have a question.
Can I just have one very quick point to that, which is that I think it's changed over time. So once upon a time, as a dividend yield hit 8-9%, you thought that's it, dividend's gone. I think these days, because this sort of valuation agnostic selling of UK equities, that's no longer the case. So you can actually find decent companies in the market yielding 8 or 9%, and actually you think they're not going to cut the dividends.
I agree with that,
Yeah, brilliant. Gentleman at the back, got time for one very quick question.
Thank you. Just following on from the earlier question about flows into UK assets and UK equities, can the panellists ever see a situation where the remaining UK institutional asset owners, such as the pension schemes or whatever schemes remain, stop sending money into alternative assets and start appreciating the dividends on offer in listed UK equities? Or is that ship now completely sailed?
Good question. I think often it's unfortunately performance begets the future flows, doesn't it? So if you did see a sudden pickup in UK equities at the same time you saw a drawdown in the US, for instance, that people might start to change. But there is a structural issue there. When you look at the weighting in domestic equities of, say, Australian pension funds, it's about 40%, and same across a lot of European countries, and we're sat at 3%. It's derisory. There needs to be some sort of regulatory change, I think, that increases that figure, because that is a big pool of capital that could potentially go back into
Great.
UK equities.
Thank you very much. I'm sorry, guys, that's all we have time for today. So thank you to my excellent panel, Faizan, Ian and Thomas, and thank you for your questions.